Welcome to another video in this Learn Prepayments and Accruals series. If you've joined the series here, go back and watch part 1 where I explain the basics of prepayments. In this video, part 2, I will share with you some prepayment examples, including how to calculate prepayments, how to post prepayments, the debits and credits, those sort of things. I will lead you by the hand. Let's jump in and get started. So, prepayment example 1. In this example, the year end, the period end, the financial year end is 31st of March 2020 whatever. Okay, 31st of March. So the year would have been 1st of April to 31st of March. That's the reporting period. It's a financial year. Now within this year, there was an insurance payment of £1,200. That could be £1,200, €1,200, 1,200 yen, $1,200. It doesn't matter where you are in the world, whichever currency that the transaction was in, the principle is still the same. So $1,200 of insurance in the financial year, in the reporting period, 31st of March 2020, whatever. This amount will show on the profit and loss as an expense. Now the thing about this $1,200 is that it covered the period January 2020, whatever, to December. So it'll be 1st of January to 31st December, 12 months. The reporting period is 31st of March. So the way this works, if we were to compare the insurance cover period to the reporting period, what you're going to have is 3 months of insurance, January, February, March, within the financial year, 31st of March, and 9 months within the next financial year. So think about that for a moment. It's important you understand this aspect of prepayments, because if you don't understand how to split the prepayments between reporting periods, you're not going to be able to do the prepayment calculation. So the year end is 31st of March. So that'll be April to March, 1st of April to 31st of March. The insurance covered January to December, so it overlaps. That insurance cover overlaps 2 financial years. 3 months within the reporting period, 31st of March 2020, whatever, and 9 months within the next financial year. Now, to help you understand this a bit better, I have this slide here. So the split, what separates the period of cover, so this is the period of cover at the top, is the period end, is the financial year end. So 3 months of cover are within the financial year that we're reporting. 9 months are the next financial year. So 3 and 9. If you need more help with this, then use the comment section below. I can help you, or even better, head over to my website, because there are examples, more examples, and I go into this in a bit more detail on my website, freebookkeepingaccounting.com. Just find the free course for prepayments and accruals, and you'll be able to read the text along with these videos. So we have our 3 months and our 9 months. So it's £1,200 worth of insurance, or €1,200, 1,200 yen, $1,200. And what we have to do is split that between the periods of cover per financial year. So if 3 months are January, February, March, we need to allocate 3 months of this expense to this financial year. And then the 9 months need allocating, April to December, to the next financial year. So the formula is 1,200 divided by 12 months will give you a cost per month. We can then times that by 3 for our 3 months and times it by 9 for our 9 months. Okay, so the formula is the total cost of the expense, the full cost of the expense, divided by the expense period. So that's £1,200, $1,200, €1,200, whatever, divided by 12 months. So 1,200 divided by 12 will give us 100. If we then times that by 3, that will give us the 300 for the financial year that we're reporting. If we times that by 9, that will give us our prepayment amount, the amount that should be allocated to the next financial year. So let's go back and just cover this formula one last time. So 1,200 divided by 12 times by 9 gives us the prepayment amount. So the full cost of the expense divided by the cover period times by the needed prepayment. So 1,200 divided by 12 times by 9. That gives us 900. So the 900 is the prepayment. Once again, there are more examples of this on my website, so go ahead and look at them. So the prepayment is 900. So there's 900 that needs moving from the profit and loss for 31st of March 2020 whatever, and allocating to the next financial year, because 900 of this 1,200 is not relevant to the current reporting period. It needs to go to the next reporting period, as covered in part 1 of this series. So the best way to do this is a journal entry. And the way we do the journal is simply do 900 debit goes to the prepayment asset. So prepayments are an asset account. They show on the balance sheet. So that's your debit entry. The credit entry is 900 insurance expense. Obviously, if this was software expense, it would be software expense. But it's debit prepayment asset, credit the relevant expense. Now, why are we doing that? We want to credit the expense because we want to bring the expense down. So in this case, in this example, we're bringing the expense down by 900. So the profit and loss will show 900 less of insurance expenses because 900 isn't relevant to that reporting period. The other side of the journal is the debit, which will show on the balance sheet, and this will actually be cleared in the next reporting period by a second journal. Now this journal will be dated the end of the reporting period. So if we go back again, so 31st March 2020 whatever, 2024, 2025, 2026, doesn't matter, whatever the reporting period is. This journal, this first journal, this prepayment journal will be dated that date, the last day of the reporting period, 31st of March 2020, whatever. Any questions, let me know below. Now as we move into the next reporting period, so in this example will be 1st of April 2020, whatever. So the first day of this prepayment, this journal will be reversed. We will credit 900 prepayments this time. That will clear the prepayments. You have 900 shown in prepayments the last day of the last reporting period. You'll then have 900 go in as a credit on the balance sheet. So that will clear that prepayment off. So that prepayment will only show you for 2 days. That last day of the reporting period and the first day of the next reporting period, it will then no longer show. They balance each other out, so they clear each other off. Then the debit is 900 insurance expense. So the profit and loss will show 900 insurance expense, which is being brought forward from the last reporting period. Does this make sense? Am I explaining this clearly enough? Once again, check out my website if you need some assistance. I know this is quite a lot to take in, but this is why it's advanced accounting. So with the journal entry here, and then the journal reversal. The journal reversal clears the prepayment asset. and then shows the expense in the reporting period. So what we've done is move 900 expense from one period to the next period. Hopefully that makes sense, because things are going to get more confusing, because in example 2 we're going to be looking at month end. Okay, so the month end, so we're doing a month end set of management accounts. Let's say as an example 30th of June 20 whatever. In this month of June there was software of 480, which actually covers 12 months. It could be June to the following May. So in this month of June, there's $480, pounds, yen, euros that shows on the profit and loss, but it's not relevant to June. Only a portion of this is, only 1/12 of this is. So we need 1/12 of this to show in June, and then we need the 11/12 to show in future reporting periods. We're trying to allocate, we're trying to spread the cost to the periods of cover. So 1 month within reporting period, 11 months within future periods. So what would the formula be again? So 480 divided by 12 times by 11. Now there is a danger here that you could do this journal. I should have put a big cross here, but I haven't. There's a danger here that you could do 480 divided by 12 times by 1 and do 40 to the prepayment asset and 40 credit software expense. It's not the reporting period amount that is the prepayment. It's the amount for the future periods or period. So it should be 440. So 480 divided by 12 times by 11. Now when it comes to the prepayment reversal for monthly prepayments, if we're doing a reporting period every month rather than every year, you don't want to do one single reversal for debit 440 software expense and credit 440 prepayment asset. Obviously this 440 will clear the prepayment asset, so the balance sheet might look a bit more tidy, but what you're going to have then is 440 showing July. So when you do the July month end, you're going to have 440 software expense showing, which means you have to do another prepayment, and you'll just keep doing them and doing them. It's never ending. What you want to do instead is just slowly ease out that prepayment month by month. So debit 40 in July, credit 40 in July. Then in August you do 40 again. September you do 40 again. October you do 40 again. So that prepayment is slowly eased out month by month, allocated month by month as the expense is incurred. So that prepayment total on the balance sheet will come down month by month until it's cleared in May. Once again, this is quite advanced stuff, so don't worry if you don't get it the first time. You can rewatch the video. Once again, there is helpful information on my website, but that's the last slide. Thank you so much for watching. This was all about prepayments. In part 3 of this series, we'll start talking about accruals. If you feel this hasn't really sunk in, I would go back to the beginning and watch part 1 again and then come back to part 2.